Welcome to this little sample here of how I teach my CFA Level II classes. Again, my name is Nathan Ronen, and the intent here is for a couple minutes to show you if you decide that you'd like me to be your instructor for the Level 2 program to get you through the Level 2 program and on to Level 3, what is it that you can anticipate from my videos, from my on-demand videos? What's his teaching style? What's he like before I decide to buy the videos and possibly not be able to get my money back, if that's always your concern. But here's the thing, I think that you're going to be very happy, so what I'd like to do is show you a little sample for a few moments about how I actually teach the material in the Level 2 program. First of all, I do not use PowerPoint slides. I don't use bullet points and all that because I think that those kinds of workbooks with PowerPoint slides or bullet points forces you to memorize rather than to understand. And on the Level 2 exam, if you're going to think that you can just memorize the entire program and then regurgitate it on the exam, you're not going to be able to do very well on those item sets. So my whole point is understand, don't memorize. To illustrate this, what I'm going to do is I'm going to take a portion of a topic that is discussed in the equity material at Level 2. And that is the concepts of free cash flow to the firm and free cash flow to the common shareholders. We designate that as FCFF for free cash flow to the firm and FCFE for free cash flow to the common shareholders. What you should see right now next to me is a little bit of 4 formulas, which are actually presented in the reading materials, in the curriculum materials, and even in the prep providers materials. So you can follow me using the curriculum materials, the CFA books, or if you purchased one of the prep providers materials like Wiley or Kaplan, Schweizer's materials, you could follow me here, and I would tell you what learning outcome statement I'm covering. But in any case, to show you here, how do we calculate free cash flow to the firm? Before we even just go and memorize these crazy formulas, I would never want to memorize these formulas because the more I memorize, the less I understand, and the more I'm inclined to make a mistake. So first of all, what I like to do is show you what is free cash flow to the firm. What are we actually capturing when we talk about free cash flow to the firm? Well, when it comes to cash flows, there's no universal definition of how to calculate the cash flows of a company. If you asked 2 analysts to calculate the cash flows of a company, they'd probably come up with 3 different answers, okay? But the point is that because there's no universal definition that says this is the way we calculate the cash flows of a company. One analyst might say, you know what, I'll just take net income and add back any kind of non-cash charges. Another analyst might say, you know what, a company's cash flows, it's cash flow from operations right off the statement of cash flows. Another one might use EBITDA as a proxy for cash flows. Many different ways that one could calculate the cash flows of a company. What the CFA program has basically done is they try to create more uniformity because they know that a lot of people are going through this program. So if they could try to harmonize or create greater uniformity in how analysts that got the charter calculate the free cash flows of a company, then they could basically say, okay, now we have greater continuity or conformity around the board. So they provide in the readings 4 different ways to calculate free cash flows to the firm. The first 3 are using what's called an income statement approach. So number 1, 2, and 3 are using an income statement approach. And the 4th formula that you see in front of you is based on the statement of cash flow. So it's a statement of cash flow approach. Briefly put, let's take a look at the first one. Before we go through the calculations, what is the definition of free cash flow to the firm? The way we define free cash flow to the firm is free cash flow to the firm is the unencumbered or unrestrained. Another word for unencumbered or unrestrained is free. The unencumbered or unrestrained cash or cash flows that are available to whom? Well, if we're looking at the firm, we're looking at all the providers of capital. Who are all the providers of capital? The bondholders, the preferred shareholders, if there are any, and the common shareholders. So we're saying that it's the unrestrained or unfettered free cash or cash flows that are available to all the providers of capital, debt holders, preferred shareholders, and common shareholders after what? After number 1, the company has paid off all other things that need to be paid off before the providers of capital can. Well, let's think about this. Number 1, who is the first party that a company has to pay if they make any money? If they make any revenues, they make any profits, they have to do what? They have to pay the government. What do they pay the government? Taxes. Well, why do we have to consider that first? Well, think about your pay. If you make $200,000 a year, you don't get to keep $200,000 a year. That's your gross income. $200,000, but then you pay taxes, and always your check is going to be taking out the taxes and some other things, but mostly taxes. And that goes to the government. So the government always gets paid first. So there's a difference between gross and net. Okay? And what is actually, again, joking here around a little bit to add some levity, what's the difference between gross and net? Gross, the difference between gross and net is what you keep, and gross is what your spouse spends. Now, I'm just kidding. You get the point. Now, again, I didn't make that gender specific, so don't sue me here or anything because I'm just joking around a little bit. But basically, the idea is you need to deduct the taxes. The difference between gross and net is the taxes that you pay to the government. So the same thing for a company. They got to pay their taxes first. Well, after they've paid their taxes, who do they then have to pay? Well, then they have to, who are they borrowing money from? They're borrowing money from common shareholders, preferred shareholders, and bondholders. What are they expecting the company to do? To grow the company. So how are they going to grow the company? By making all kinds of capital expenditures and changes in working capital. They're going to invest in inventory. They're going to buy inventory. They're going to have all kinds of accounts receivables as a result when they undertake the project or start the business. So basically, before they can pay out anything in terms of cash or cash flows to the providers of capital, a company must pay its taxes and then make its fixed capital investments, its capital expenditures, and its changes in net working capital or net working assets. Those three have to be satisfied, and then only after then we could say whatever is left over is available to the providers of capital in the form of interest to bondholders and dividends to the preferred shareholders and common shareholders. So now that we understand what is free cash flow to the firm, that it's the unrestrained or unfettered cash or cash flows that are available to all the providers of capital after the company has paid its taxes, made its fixed capital investments and working capital investments, we can now explore formula number one to see how we come up with this formula through an understanding rather than a memorization. So with the income statement approach in number one, free cash flow to the firm number one, what we could do is we could start out with the bottom of the income statement, which is the bottom line of the income statement is net income. And what we could do is we could say, well, net income is technically cash flow that's available to whom? To the common shareholders. But wait a second, we need to come up with the cash flows available to all the providers of capital. First of all, we need to understand, did we pay our taxes? Number one, did we pay our taxes? The answer is yes, we paid our taxes because net income is after tax. So we have paid the government their taxes. So that's fine. However, net income, when we look at net income, did we make our fixed capital investments? Net income does not include the fixed capital investments, but we need to make those fixed capital investments and make those fixed capital investments so that we can grow the company for the benefit of the providers of capital. When we make those fixed capital investments, when we make those capital expenditures, let's say that they are for cash. Where does that appear? It appears on the balance sheet and it appears on the statement of cash flows, but it doesn't appear on the income statement. Why? Because when we make the fixed capital expenditures, plant and equipment, we put them as an asset on the balance sheet called property, plant, and equipment. And then what do? On the statement of cash flows, we show it as if we paid for it in cash, we show it as a cash flow from investing outflow. So it shows up on the balance sheet and the statement of cash flows, but that expenditure does not show up on the income statement immediately. Eventually, what are we going to do? We're going to depreciate it, but depreciation is not a cash expense. So therefore, what we need to do is, since we're starting out with net income on the income statement, we have to adjust it for taxes, which we've already done because net income is after tax. And then we have to deduct any fixed capital expenditures or fixed capital investments because they do not appear on the income statement and they are an outflow of cash. And then also we have to adjust for any kind of working capital investments. What are working capital investments? Working capital investments, which you see in parentheses, the change in net working assets. Well, if we're going to undertake a project, we're also going to have to spend a little bit. So what's going to happen? We're going to have to buy inventory. When we buy inventory, that's a cash outflow. That cash outflow for the inventory shows up on the balance sheet as inventory. And then it shows up on the statement of cash flows as a working capital item, as an outflow from operations. But it doesn't hit the income statement until when? Until we actually sell the inventory. So therefore, because we're starting out with net income, we know we also have to make working capital investments, such as investments in inventory. We're also going to have accounts receivables because when we make a sale, we're going to probably make the sale on credit All of those sales, again, they're not going to be recorded immediately. So what's going to happen is we're going to have all of these working capital investments. And the net change in those working capital investments, the net working assets, has to be subtracted. So we subtract, and notice how I put this in parentheses, we subtract the change. Delta means the change in the net working assets. And I'll try to explain that a little bit more later on. But again, this is a limited just review of how I teach in class or how I teach in my sessions. So what we have here is if we're using the income statement approach in number one, we're taking net income, we're subtracting any kind of taxes which have already been done, so we don't have any further adjustment for that because net income is after tax. And we're subtracting fixed capital investments because they're not on the income statement, but they are an outflow of cash. And we're also subtracting any changes in net working assets. And make sure you have it the way I have it, minus, and then in parentheses, the change in net working assets. Now, so therefore we've done all of what we've done. We've paid our taxes, we made our fixed capital and working capital investments. But is net income truly cash? No, because some of the revenues and some of the expenses on the income statement are going to be cash revenues and cash expenses, and some of them are also going to be non-cash expenses. What are examples of non-cash expenses? Depreciation, amortization, depletion, restructuring charges, losses due to the impairment of assets, losses due to write-downs, all of that kind of stuff. Well, all of those are what we call non-cash charges, NCC, non-cash charges. So what we need to do is we realize that on the income statement, any of these non-cash charges like depreciation, amortization, and depletion reduced net income. But did we ever pay them out in cash? No. We were just able to reduce our taxable bill. But hold on a second. So depreciation, amortization, depletion are non-cash charges. So they reduced net income, but we never paid it out in cash. It stays with the company. And if it stays with the company, who does it belong to? The providers of capital. So therefore, because we deducted it on the income statement, we now have to add it back to net income because these are cash flows that never went out. They just reduced net income, but they never went out. So we add them back because they are available to all the providers of capital. So we take net income, we add back any non-cash charges from the income statement, we subtract any fixed capital investments, and we also subtract the change in net working assets. And then the last component is to understand, well, now that we've added back the non-cash charges and we've paid our taxes, we've made our fixed capital investments and our working capital investments, we should technically have the amount that's available to the providers of capital. Not yet. Why? Because now net income is what? Net income is a number that's available to whom? To the shareholders, both the preferred shareholders and the common shareholders. Okay? We'll assume that there are no preferred shareholders, so the net income is available to the common shareholders because not most companies don't always have preferred shares. So the net income is a cash flow that's available to the common shareholders, and that could technically be paid out as a dividend, correct? If they wanted to, they could pay out all of their net income as a dividend, not retaining anything, but that's unusual. However, net income is post the deduction of interest expense. Now, here's an important part. It's post the interest expense, meaning that net income is after the deduction of interest expense because we take our revenues, we take our operating expenses, we come up with EBIT, and from EBIT we subtract interest and taxes. So we deducted interest expense, but who is interest expense available to? Interest expense is available to the bondholders. Aren't the bondholders one of the providers of capital? Yes. So basically, net income is after deducting interest, but not after deducting dividends, correct? So therefore, because we deducted the interest expense, it's a pre-tax cash flow. Because we actually paid the bondholders that interest expense, we have to add back that interest expense to come up with free cash flow to all the providers of capital. So we add back that interest expense. But notice, do we add back the entire interest expense? No. We take the interest expense and we multiply it by 1 minus t. Net interest expense times 1 minus t is what we call the net interest expense because we taxed the interest expense, and the leftover amount is what we call the net interest expense. So we have gross interest, then we have some of it that's paid in the form of tax. We apply the tax rate, that's a taxable part, and then we're left with what's called the net interest expense. So interest expense times 1 minus t gives you the net interest expense. Now, why are we adding that back? Why don't we just add back the entire interest expense? Because in the United States of America, so far, interest expense is tax deductible. Now, what does that mean that it's tax deductible? When interest expense is tax deductible, just like the interest on your mortgage, which, well, we're going to see how long that lasts, but interest expense is tax deductible means that the more interest you have, you can deduct that interest when you come down to your taxable income base. So the more interest expense you have, the more tax deduction you have, the lower your taxable income. The lower taxable income, the less you pay in taxes to the IRS, to the federal government. So in essence, interest expense is what we call a tax. It's a tax shield. It shields taxable income from taxation by reducing the taxable income. But wait a second, if the taxable income is being reduced because of the interest expense and you're not paying as much taxes, where's that money staying? It's staying in the company's pockets. And if that money that they're not paying out in the form of taxes, because interest expense is tax deductible, is staying in the company's pockets, who does that belong to? The providers of capital. Okay? So basically what we have to do is we have to come up with the net number. Why? Because the interest expense that we're paying to the bondholder is an outflow, but the tax savings from the deductibility of interest expense is a cash inflow because we're not paying out as much taxes. So here's the idea. Let's say you have a 6% coupon bond. You bought a bond with a 6% coupon. Based on a face value of $1,000, you're going to get interest as a bondholder of $60. You, the bondholder, are going to get $60. Let's take a look at this from the company's perspective, though. They're going to pay you $60, right? So they have a cash outflow of $60. But at the end of the day, do they really, on a net basis, pay you $60? No, because the interest expense that they just paid you, that coupon cash flow, is going to come back to them. A portion of that is going to come back to them in the form of the deductibility of interest expense. So let's say the tax rate of the company is 40%. On that $60 times 40%, $24 is going to be basically is going to be a tax savings. It's going to be a tax savings. The $24. $60 times 40% is $24, and the remaining $36 is what they have on a net basis actually paid the bondholder. So in other words, they paid the bondholder $60, but they got a kickback of $24 from the government in the form of a tax deduction or the deductibility of interest expense. So on a net basis, they only really had an outflow of $36 to the bondholder. That's why we add back the $36 in my example, not the full $60. We add back the net interest expense. Okay, hopefully that makes sense. So the coupon cash flow is an outflow, but the reduction in taxes is a net as an inflow, so we need to add back the net amount because that is what they've effectively paid the bondholder. So that is the explanation for free cash flow to the firm number 1. To distinguish this from free cash flow to the firm number 2 very quickly, we're going to still use an income statement approach, but we're going to go up the income statement. We're going to go from net income to EBIT. Well, with EBIT, earnings before interest and taxes, we call that the operating profits of the firms. Number 1, we have to ask ourselves, who's the first party that needs to get paid? Uncle Sam, the government. EBIT, is that pre-tax or after tax? EBIT is pre-tax, so we did not pay our taxes. So therefore, we need to tax the EBIT. And when we take EBIT times the tax rate, we're left with EBIT times 1 minus T. We're left with the net EBIT. So therefore, now by taking EBIT and multiplying by 1 minus T, we have what is called the net EBIT because we have now taxed the EBIT. We've taxed the operating profits and we're left with EBIT times 1 minus T. Now, what happens is we still have to deduct our fixed capital investments and our working capital investment, so that stays the same because that, as I said earlier, does not appear on our income statement. It appears on the balance sheet and on the statement of cash flows, but it is an outflow of cash, so we need to reflect it as a reduction of the EBIT. And then what we need to do is we need to add back the non-cash charges. Okay, we add back the non-cash charges. Why? Because depreciation, amortization, depletion, and other types of non-cash charges are usually going to be above EBIT, meaning they're going to be before the deduction of interest and taxes. In other words, what's above EBIT? EBIT, as I said before, is operating profits. We're going to have our operating revenues minus all of our operating expenses, such as cost of goods sold, depreciation, amortization, depletion, any kind of other expenses that a company might have, wage expense, rent expense, insurance expense, everything other than interest and taxes, because interest and taxes is below EBIT. So basically, we have deducted depreciation, amortization, and depletion. And even though depreciation, amortization, and depletion are tax shields, they shield income from taxation, they are non-cash. So therefore, because we deducted them in full to come up with EBIT, we have to add them back in full. So we add back all of the non-cash charges. And therefore, we get left with this formula number 2. So you might be saying, hey, Nathan, what happened to the interest expense? Why aren't you adding back the interest expense like you did in the first formula, the after-tax interest expense? Well, take a look at the first formula. Take a look again at the first formula. How are we adding back the interest expense? We're adding back the after-tax interest expense. So we're being left with the after-tax interest expense or net interest expense. Now take a look at formula number 2. What are you doing to EBIT? You're multiplying it by the tax rate and you're being left with EBIT times 1 minus T. In other words, what you did was you taxed the entire EBIT, correct? You taxed the entire EBIT. So in that EBIT, is the interest expense in EBIT? Is interest expense in EBIT? Yes, it is. Why? Because we have not taken out the interest expense. When do we take the interest expense out? After we come up with EBIT, because interest expense is below EBIT on the income statement. So we have not yet deducted interest expense. But did we tax that interest expense? We sure did, because we taxed the EBIT. And in that EBIT is the interest expense, so we technically taxed the interest expense. So if we tax the interest expense, what are we left with after we tax it? Well, if we tax the EBIT, we're left with the after-tax EBIT. So if we tax the interest expense, we're left with the after-tax interest expense. So now by taxing the entire EBIT and by extension taxing the interest expense, which is in the EBIT, we have interest expense on a after-tax basis. So therefore, we don't need to make any further adjustments because interest expense is now on an after-tax basis, just like it is in the first free cash flow formula. Now in class, I would actually then go over free cash flow number 3 and number 4, and again explain why EBITDA times 1 minus T and all that, and explain to you that why EBITDA is a poor proxy for free cash flow to the firm, and show you and basically come to a problem in an item set format to show you how to apply this material. But again, this is just a short snippet that we've created, or that I've created, to sort of show you my teaching style, which is all about learning and understanding, not memorizing, so that you can, if you have to do these calculations, you can reproduce the formulas in your head. In case you forgot them, you can reproduce them in your head and be able to answer the questions without having to memorize them. Thank you very much for just watching this small snippet. Again, if you ever want to reach me, my email address and my phone number is on our website at Chalk and Board. So I'm happy to answer any of your questions, and I hope that I'll see you in one of my classes, hopefully at level 2 and even later on at level 3. Thank you for watching this.